A very warm welcome to the launch of the OECD's 2025 Global Debt Report. This second edition analyzes the latest trends in global debt markets up to the end of 2024, and it provides evidence-based recommendations to enhance debt sustainability. By 2024, governments and companies significantly ramped up their borrowing compared to previous decades. Last year alone, governments and companies around the world borrowed $25 trillion US from markets. That's about $10 trillion US more than the pre-COVID average between 2015 and 2019, and triple the amount in 2007. In emerging markets and developing economies, bond issuance tripled from $1 trillion US in 2007 to $3 trillion US in 2024. And corporate debt reached a historical high of $35 trillion US at the end of 2024, an increase of 62% in real terms since 2008, driven by non-financial issuers in the main. Both corporate and sovereign debt will continue to grow this year. The central government marketable debt is expected to reach 85% of GDP in 2025 across the OECD, which is more than 10 percentage points higher than in 2019 and twice the level in 2007. And around 40% of all sovereign and corporate debt is set to mature in the next 3 years, which will likely be refinanced at higher interest rates. In 2024, over half of OECD sovereign debt and nearly 2/3 of investment-grade corporate debt had interest costs below prevailing market rates. Higher borrowing costs are already weighing on public finances. Government interest payments increased as a share of GDP in about 2/3 of OECD countries in 2024, reaching 3.3% on average, a 0.3% increase on 2023. Past corporate borrowings are used for financial operations like shareholder payouts rather than productive long-term investments, risks undermining debt sustainability. While cumulative bond issuance by non-financial companies between 2009 and 2023 was $12.9 trillion higher than the pre-2008 trend, corporate investment grew by $8.4 trillion US less than the pre-2009 trend. Between 2000 and 2021, 72% of corporate bond prospectuses mentioned refinancings and 9% mentioned shareholder payouts. These pressures on debt sustainability come at a time of increased debt market volatility. As central banks progressively withdraw from debt markets, more price-sensitive investors are absorbing the growing supply of bonds, which can add to volatility, particularly at times of heightened market stress. In 2024, the share of sovereign marketable debt held by households reached 11%, up from 5% in 2021, just 3 years earlier. And the share held by foreign investors reached 34%, up from 25%. Rising geopolitical tensions and trade uncertainties may lead to rapid increases in risk aversion among these investors that could, in turn, disrupt international portfolio flows. Debt pressures will make it more difficult to meet pressing spending needs. For businesses to finance innovation, technology deployment and expansions in their operations, ultimately driving much needed growth. And for governments to respond to population aging and the rising demands on healthcare and support systems, to make investments in productivity-enhancing infrastructure, to finance higher defense spending, or indeed to expand digital connectivity and make progress on the green transition. Our analysis highlights three key policy priorities for navigating current pressures on debt markets. First, there is a need to strengthen government's fiscal discipline and resilience to market fluctuations. Prioritizing borrowing for productivity-enhancing investment that boosts long-term growth, optimizing tax revenues, and improving the efficiency and the targeting of spending, for instance, through spending reviews, will be key, as will be structural reforms that boost the foundations for growth, including tackling red tape and burdensome regulations. This edition of the Global Debt Report also shows that emerging economies that borrow mainly in their own currency have fared better than those that mainly borrow in foreign currencies, enjoying greater market access on more preferable terms. Continuing to develop local currency markets will help emerging markets and developing economies build resilience to the impact of international market fluctuations. Second, incentivizing companies to borrow for productive investments. Providing more certainty on regulations that affect the profitability of long-term investments, such as taxation and environmental regulations, will encourage businesses to borrow to enhance their productive capacity. Sound corporate governance frameworks that ensure transparency and accountability of board members to shareholders will also be incredibly important to protect shareholders' interests, including for retail and foreign investors. And more efficient capital markets with greater depth and liquidity, lower transaction costs, and more efficient pricing will also help investors make more long-term commitments. In Europe, for example, better linking domestic capital markets would both benefit savers through higher returns and would also help enhance businesses' access to longer-term financing. Third, unlocking greater private investment in the climate transition. If governments were to finance the climate transition on their own, this would result in an increase in the debt to GDP ratios of 25 percentage points by 2050 across advanced economies. Well-functioning private debt markets therefore have a key role to play in providing companies with the financing they need to invest in green energy and infrastructure. For instance, in emerging markets, bonds issued by energy companies would need to grow at an annual rate of 17% through 2050 to meet the investment demands of the green transition. To unlock this potential and this need, reforms to enhance capital market development in emerging markets and developing economies, including to improve investor protection, stabilize currency markets, and reduce macroeconomic volatility, will be very important. In closing, in the current context of increasing pressures on public and corporate finances, prioritizing those investments that help fuel longer-term growth prospects and prosperity will be key. Strong fiscal discipline, a commitment to building investor confidence through robust corporate governance and regulatory stability, and developing local capital and debt markets, especially in emerging markets and developing economies, will also be necessary to improve debt sustainability in the years to come. So with those few introductory remarks, I now hand the floor to Carmina Di Noia to present the detailed findings in the 2025 Global Debt Report. Thank you very much.
Thank you, Secretary General, and welcome to everyone also online. Now, the global economy and financial markets has seen so much change and volatility over the past few years that even the broad direction of travel sometimes feels difficult to pin down. But with all these rapid twists and turns, so it's important that the structural issues don't get lost in a sea of changing narratives. So policy making must proceed from a basis of evidence and analysis of the longer-term trends. And so our job at the OECD is to help provide this basis. And actually, so the ambition for this second edition of the Global Debt Report is to be a useful tool to help policymakers and deal with the challenges facing today's debt markets. Now, this year edition, which has been prepared by the excellent team in Capital Markets and Financial Institution Division, has 4 chapters. 2 are, I would say, the core on developments in sovereign and corporate debt markets, and 2 special chapters on emerging market sovereign debt and markets and climate finance. Now, as it was mentioned by Secretary General, today's debt markets are the legacy of these centuries two, defining crisis. So the 2008 financial crisis and the COVID-19 pandemic. Now, in response to both, debt markets enabled the funding of large fiscal support packages that helped avoid the deeper recessions. And expansionary monetary policies were implemented for the same purpose, so enabling large increases in borrowing across the board. Both occasions are clearly visible here, both on the left in terms of levels, and on the right in the spikes in issuance to GDP ratios in 2009 and 2020. Now, what is remarkable is that these spikes were not one-off increases. So in both cases, rather than then returning to pre-crisis trends, borrowing levels basically have remained at new highs. And as Secretary General noted, so total global bond issuance, so both sovereign and corporate, amounted to $25 trillion last year. So more than triple, the amount in 2007, as you can see on the left. Now, from 15% of GDP in 2008, total bond issuance jumped 3 percentage points to an average of 18% from 2009 to 2019, and then another 5 percentage points to 23% from 2020 to 2024. And this increase reflects basically a growth in borrowing across all market segments. So from OECD and emerging market sovereigns to investment grade and non-investment grade companies globally. These are the borrowing, the flows, and let's go to the stock. So those crises have left their mark, as is evident here, even after actually adjusting for inflation. So these are inflation adjusted 2024 data. The OECD sovereign debt stock is 76%, so 3/4 larger than in 2007. 119% larger for emerging market sovereign in between, and 62% larger for corporations globally. Now, in an environment with this level of debt, we should be clear-sighted about 2 things that might seem, on the face of it, in a sense, conflicting. Now, first, going big on the fiscal responses to those crises was the right decision. At its core, this is exactly the role of the modern state is really to provide an insurance against these types of shocks, of macro shocks, unexpected, which actually no other actor can do, has the capacity of doing. So then we can discuss, the magnitude, the design, the length of those interventions. But in general, a significant fiscal response was appropriate on both occasions. The second, then, the trajectory of debt ratios may not be sustainable, and measures to stabilize and eventually reduce them are so required. But these things, both of them, these things are true, and it's important that we make future policy decisions with that in mind. So debt, and in particular, marketable debt bonds, is a useful instrument. But it's not without cost. Actually, those costs have not been very prominent in recent years. Across the globe, 15 years of expansionary monetary policy has driven, down debt costs in almost all market segments. In 2000, two-thirds of all fixed rate OECD sovereign debt had an interest cost above 4%, as you can see on the left. You see how high it is. By 2024, that had fallen to 13%. At the peak in 2022, negative yielding debt, which is a concept that probably in Econ 101 courses, you would likely struggle to explain to someone, even 20 years ago, made up close to 10% of the OECD fixed rate debt stock. And even the riskiest corporate market segments, you see on the right, have been able to borrow at rates that were previously reserved just for high, credit quality sovereigns, as again, you can see on the right. Basically, bonds with the interest rates above 10% used to be the norm for non-investment grade companies back in 2000, making up roughly half, you see 50% more or less of outstanding debt at this time. And at that time, and you see the purple. And now only 3% of the non-investment grade debt stock carries those costs. So this is also important, is good. Many corporates enter the market, even the riskiest one, which is also after the crisis or the bank regulation, having a different source of financing rather than maybe bank loans. So this is the positive part. But that is changing. The period of ultra-low interest rates, it's over. And markets need to reckon with a new reality that isn't yet actually fully reflected in debt stocks. At the end of 2024, the majority of outstanding global bond debt had interest costs below the relevant reference yield, which we can use as a proxy for the cost of refinancing that same debt. And this is actually, as you see now on the left for global sovereign, is the highest level in recent history. And also you see on the right for corporate borrowers. So globally, on the left, 56% of sovereign debt had lower costs than prevailing yields at the end of 2024. And for investment grade corporations on the right, the figure was 63%. So unless yields fall very rapidly, these will continue translating into higher debt servicing costs. And that's a reality which cannot be avoided or ignored. And it's happening at a time and OECD governments' interest expenditures are already higher than their, for example, total defense spending, as noted by Secretary General. So we need to be clear about this. On the current trajectory, a growing share of government and corporate funds globally will go to debt servicing as existing borrowing comes due into the next few years. And higher debt costs are and will continue then in particular to hit the riskiest market segments. So the riskiest, the hardest. For sovereign issuers, which is here, that's the most exposed group is the low-income group of countries. As major economies have tightened their monetary policies, this has directly increased the cost of foreign currency borrowing. So consequently, some issuers, especially the poorest countries, have begun to withdraw from foreign markets, as you can see here on the right, basically the last two figures. So lower middle income and low income countries have had significantly negative net issuance in foreign markets since 2022. And these will pose challenges for these countries, some of which are only able to access international debt market through foreign currency issuance, as was mentioned Secretary General, because there is basically no then possibility, there is no local market. Another interesting figure is this, and this is really a crucial point, both in a macro level and micro level. Now, the ability of borrowers, around the world to deal with higher costs of debt depend in part on how they have used the proceeds from that borrowing. And even a high debt stock can, in effect, pay for itself if the money was used for productive investment that enhances growth and so therefore future repayment capacities. If it was not, you'll be left with a slow-growing, denominator, meaning relative debt costs become increasingly difficult to bear. So understanding what the debt was used for is therefore a critical element in assessing its sustainability. Now, the figure here shows what happened in the corporate sector. Now, increases in borrowing here have not been associated with corresponding increases in investment. So in this graph, actually, we look at the pre-2008 trend for both corporate borrowing and investment. So measure the investment as the sum of capital expenditure of CapEx and R&D. So as you can see, corporate borrowing has been significantly above trend since 2008. And this is basically the blue area, represents the total borrowing above trend. But there is no such, let's say, trend break when it comes to investment. And instead, so companies have mostly issued debt to refinance existing borrowing at lower cost, and basically for financial management purposes. So working capital operations and maybe shareholder payouts, like dividends, buybacks. Okay. Another element that adds actually additional complexity to the situation. And this is the changes in investor base, as was also mentioned by Secretary General. Basically, central banks continue to withdraw from debt markets through quantitative tightening, also in 2024. So this has removed an enormous source of downward pressure on yields for sovereigns directly, but also indirectly on corporates. As shown here, so back in 2021, central banks held 29%, so nearly 30% of all OECD sovereign debt. And that has since fallen 10 percentage points down to 19%. And if existing levels of debt are to be maintained, so going forward, so other investors will need to buy more debt. And actually, for now, domestic households and foreign investors, which are likely more price sensitive, they have replaced central bank. It's exactly the same difference: 10 percentage point, 11 percentage point. Okay. But there are two important questions to consider. Firstly, what will be the second-order effect on other markets, notably for corporate and emerging market sovereign debt, as basically investors reallocate back into OECD sovereign debt and so out of other market segments? So there may be enough demand to sustain increased OECD sovereign borrowing, but what about other borrowers? And so the emerging market, foreign currency net issuance, that figure that I showed before, might offer a hint. And secondly, how stable is foreign demand? As noted by Secretary General, ongoing geopolitical tensions and trade policy uncertainty may mean a net decrease in demand in some market segments due to increased risk aversion. And these challenges, and so this is also in the last part of the report, a new part, are present at a time when future investment needs are both massive and unavoidable. Specifically, the transition to net zero is taking place in an environment of high debt levels and rising interest costs. So in a thematic chapter, again, of the report, the fourth, we look at different paths to net zero. So depending on whether basically the public or private sector provides, the bulk of the necessary investment. And all scenarios illustrate, the magnitude of the challenges ahead, but actually also demonstrate that net zero is not an impossibility. Now, in the baseline scenario, that is, if investment follows recent trends, shown here on the left, advanced economies would face a cumulative investment shortfall of $2.4 trillion US dollars by 2033. This gap would close only in 2041, putting advanced economies back on track with the Paris Agreement aligned pathway in 15 years' time. Now, if the public sector in advanced economies were to bridge the investment gap, clean energy investments would need to grow significantly by 24% annually in the next 5 years. And the impact on public debt would also be substantial in the absence of higher taxes or public spending cuts in other areas. Higher climate investments alone would raise public debt to GDP by 25 percentage points in advanced economies by 2050. Conversely, if private capital on the right were to fund most of the investment, corporate borrowing would need to expand substantially. Bond markets for energy companies, which is one of the scenario simulation in advanced economies, would need to grow at an annual rate of 3.8% between 2024 and 2035, as shown on the right. And so while these may be entirely feasible in advanced economies with well-developed capital markets, it may pose challenges for others. And I'm going to the last slide. Now, this slide basically shows the same scenarios for emerging markets other than China. So the countries for which the transition will be the greatest challenge. Now, in the baseline scenario shown on the left here, emerging markets would face an investment shortfall of $10 trillion US dollars by 2050. If the public sector alone were to fill this investment gap, public debt to GDP ratios would increase significantly in emerging markets other than China. The increase would be 16 percentage points by 2040, beyond which further fiscal expansion may not be sustainable, so necessitating additional support from advanced economies. Conversely, if private capital were to fund most investment, corporate borrowing would need to expand substantially. Bond markets for energy companies in emerging markets would need to grow at an important annual rate of 17% between 2024 and 2035. So this would represent an increase from $500 billion to $2.8 trillion during the same period, as shown on the extreme right. So these projections highlight the immense challenge of leveraging debt markets for a low carbon transition and the critical role of the private sector in driving this transformation, but also as that a mix of this can be the solution. So unlocking this potential requires regulatory reforms, particularly, as also was mentioned by Secretary General, to enhance capital markets development in emerging markets. So I conclude the presentation. So thank you, and we are here, but also today or afterwards, to answer all questions or curiosities.
Carmine, thank you very much for. Thank you very much for that presentation. We're going to go straight into a few questions that have come in on the Zoom. Begin with one on inflation. A lot of indicators inflation may be picking up again. You've noticed it also in the OECD's interim economic outlook presented earlier this week. What impact would rising inflation have on debt markets?
Thank you for the question. Now, I mean, higher inflation, other things being equal, which is always what the economists say, increase the likelihood of an extended period of more restrictive monetary policy, and this would put pressure on debt markets, basically for basically higher financing cost for continuing issuer. I mean, markets are liquid, but maybe also difficult of access for some some other, issuers like emerging markets or low income and others. The second, actually, if, as also we mentioned briefly, if basically central banks, monetary policy is there, again, other things being equal, there will be an increasing supply of bonds on the market, and which is, again, need to be absorbed. And third, I think this we have seen already on some of the markets, actually, other things being equal, basically the uncertainty and make people, investors, move away from long-term bonds and maybe go to shorter term and maybe inflation-linked bonds. And so in general, these like the slide we showed, basically these investors, again, households and foreign investors are more price sensitive. So I think these may increase volatility on the markets.
Thank you. Just encourage those watching online, journalists, to please go ahead, keep putting your questions into the Zoom. We'll go to another one, and this time about question of increased defense spending, which seems to be coming in many countries across Europe. Even a massive increase in debt-financed defense and infrastructure spending. What could this mean for debt markets?
Again, other things being equal, increase the defense spending must be funded, and in different areas we see different proposals and responses. Also recently in these days and in these hours. So on the one side, these increases again the supply on the market by governments, but then this is a supply. The defense spending can be very different areas and may mean many different things. But as a proxy, we can use what may happen on the market, what happened, for example, in Germany, basically, announced the announcement of a massive, and this was a big novelty for the markets, and massive, spending and linked to defense. What happened on the market in that case is that basically, okay, there was a spike, an increase in the yields that we have never seen, I think from the 90s. But actually, this was really, shows an increase in the rate rather than a doubt in the credit quality or let's say the credit risk, for example, of Germany. Obviously, Germany is a special case, is a case of a country with low, debt to GDP. And actually, even the stock market, and so this is also very much related to the question, because defense means also investing in some important corporates. The stock market reacted positively. The euro actually appreciated. And even rating agencies, for the case of Germany, basically said, okay, this is actually even supporting the high rating, not decreasing. But obviously, there are different cases, different countries. So then these are for advanced economies, very liquid markets, but on the same time, for others, maybe less liquid. And we have seen even for OECD countries in recent periods that this cannot be taken for granted, that you can tap the market every time, whenever you want.
I have a follow-up question linked also to the defense spending topic, which is the specific case of the UK. Any challenges and trade-offs that you see them facing, given the pressures from high debt levels as they ramp up defense spending, specifically the UK? Actually, UK is one of the cases, for example, that I had in mind, before. Again, advanced economies, OECD countries, markets are very deep and liquid. So even with a high level of debt, and we see also in other countries actually where structurally we have high level of debt for many years. I mean, the increase may not be so creating so many tensions of being structured. But at the same time, I think transparency, clear plans, exactly where you're spending, also debt management, understanding also every moment where is the demand and supply, because again, in the UK, we have seen for a short period of time, when it was 1.5 years ago, that there were big tensions on the market. Thank you. Another question coming from the Zoom. and it's a two-parter. What do you see as the biggest risk facing sovereign borrowers? What do you see as the biggest risk facing corporate borrowers?
Yeah, we have seen, okay, we have shown also some of the data, but I will not put again. I mean, one big issue is, and we mentioned, but we can, is refinancing risk. Basically, a big part of the debt and sovereign debt, but also corporate, is also going to expire, in the next 3 years. And again, refinancing would be at much higher cost than what has been there. So basically, for advanced economies, again, I think they can go on the market. Even this substitution effect, liquidity is there, and again, we may have a different composition of buyers of this debt, of new debt. But again, this shouldn't be taken for granted. It's not, that liquidity just there. Markets are always supply and demand, so it's important also to satisfy also the needs of investors. Europe, there was the savings and investment communication. So it's important also to be clear, transparent, plans, forecast, clarity in the spending. For emerging markets, I think the situation may be difficult, and especially for some segments, they issue some of them that have the capacity of local markets. Some others, they do not have this capacity, so they issue in foreign currency abroad. And so tensions that may be there may really close the markets to them, as we have seen. So also having, also more transparency around, resolution schemes, agreements, support from international institutions. But again, also data, availability of data, and this is something that can really help, tap in the market. And also at the micro level, I would say this is also, our role, the work that we're doing, also having the market microstructure well developed, having, debt and cash management very well, organized from debt offices. I think other things being equal can help also to reduce the cost of new debt, other things being equal.
Carmine, thank you very much. We've gone through the questions we've received from the media online. And so with that, I think we're going to close the press conference. All the information is available, of course, on the OECD website. Thank you very much. Have a nice day.